So in the foreign exchange market, we have different types of orders that we can actually execute as traders. We have market orders and pending or limit orders. So if you're executing a market order, it simply means you are willing to buy or sell at the current market price. So you enter a position in your account, in your trading account, based on the current market price. So you look at the current market price, you see that price maybe would rise or would fall. There is where you enter your trade. Personally, I use market orders. I execute based on market orders. And we also have pending orders. And for pending orders, if you're putting in a pending order, that means you're willing to buy or sell at a specified price and a specified time, or maybe at a specified price and no specified time. So you may put an order, For example, you may have a market where price it is at this point, So maybe price here is around 1.1305. And you see that if price goes to 1.13, maybe 1350, and touches this price level, So if you assume that price goes to 1350 and touches this price level, then price would drop, So you're very sure that if price reaches this price level, it will reverse, the market will reverse, and the market will start selling. So you put in a position here, a pending order, to sell when the market reaches that level. While its price is at this level, So when you're executing that order, price is at this level, and the pending order would remain pending until the market reaches that level, and the order will be executed, and your order will be running. So if the market sells, you'll be in profit. If the market buys, then it will be going against you, and you will be in loss. So that's how pending orders work, You want to buy or sell at a specified price level. In the pending orders, we have the limit orders and the stop orders. So we have the buy limit and the sell limit, and we have the buy stop and the sell stops. So a buy limit is a buy pending order below the current market price. So the market has been buying, And you see that the market would retrace to a certain price level and then continue to buy, Okay, so the market is buying. It's at this level. You see that it will retrace to this level and then it will buy. So you put your buy limit order here, while its price is at this level. So a buy pending order below the current market price. The current market price is above. You put your buy pending order here. So supposedly the market comes to this price level, it would execute your buy pending order, and it will be a running order now. And if the market buys, then you will be in profit. We also have a sell limit. A sell limit is a sell pending order above the current market price. Okay, so you see the market is buying, And you see that if the market reaches to this price level, then the market will start to sell. Therefore, you put a sell pending order at this price level, and that order will remain pending. The market, supposedly it will come to this level, that order will be executed, and it will now be a running order, If the market sells, it is in your favor, you are in profit. We also have the stop orders, And we have the buy stops and the sell stops. So for a buy stop, this means you are willing to buy above the current market price. And this is mostly used by what we call breakout traders. So you see the market, maybe it's on a range, on a certain range, and you feel that if the market breaks above this range, the market will buy significantly. So you put your buy pending order at this area, whilst the market is at this price level. And if the market comes and breaks this level and reaches this price level, then your order will be executed. And if it continues to buy, then you are in profit. So you are a willing buyer above the current market price. You see that if the market touches a certain level of price, which is higher than the current level, then it would continue to buy significantly. And for a sell stop, that means you're a willing seller below the current market price. The market is actually selling, and you see if it breaks a certain area, then it will continue to sell significantly. So you put your sell stop at that area whilst the market is still up here. So if the market reaches that point, the order will be executed. And if it goes in your favor, you'll be in profit. So these limit orders, these buy stop orders, these sell stop orders are mostly used by people who are not in the market all the time. So you do your analysis, you anticipate your zones, you anticipate that price reaches this level and then it will do this. Therefore, you put a pending order there and you leave it be. So it is mostly used by those who are occupied by other works, and therefore they cannot be in the market all the time. Sometimes we have traders in time zones that are not favorable to trade during certain, like during London session or during New York session. So they will put pending orders. We also have what we call stop loss level and take profit level. So a stop loss serves to minimize losses in the event that the price of the currency pair starts to move in the direction contrary to that which the market had believed it would. So you take your buy order. You take your buy order and you want the market to buy. What if the market goes against you? How do you minimize your loss? You put what we call a stop loss on that order. That if it reaches this price level, which is against me, your order should be closed automatically. That's how a stop loss work. And if the market goes against you and actually reaches this level, then your order will be automatically closed in a loss. And we also have what we call a take profit. Take profit. A take profit is our target profit area. A take profit is our target profit area. So you took this buy trade and you assume that it will reach a certain price level above here. So maybe 1.1400. So you put this price as your take profit level. So if that market reaches 1.1400, then your order will be closed automatically in profit. So the stop loss and the take profit level, the stop loss and the take profit levels are there to save us when we are actually not in the market. And sometimes the market is highly volatile that if you don't put a take profit, if you don't put a stop loss, and the volatility occurs, then you find you might miss the dollars that you should have earned because you do not have a take profit, or you might get a bigger loss because you don't have a stop loss. And in trading, you should always have a take profit target because you're here to make money. So why don't you have a target area? Like where should the market go and you actually close your profit? Because if you don't close that profit, it is not yours. So You should always have a target area for your profits. So you should have a top profit, and you should always mitigate your risk by using a stop loss. So you should always treat this market when you're using technical analysis as each trade may go into loss. So each trade may go into loss. So you should have a stop loss level there. Although you might have, with the strategy, you might see some trades that are high probable and take a trade, but you should always use a stop loss. Stop loss is there to minimize your risk. It's part of the risk management plan.